Hey everyone, and welcome. Today, we're going to pull back the curtain on something that pretty much affects all of us, but can feel like a total black box: how your insurance premium is really calculated. We're going to break down exactly what goes into that final number you see, making it all make sense.
Okay, so this is the big one, right? We've all been there. You hear what your friend is paying for the same car, and it's completely different from your bill. It can feel totally random, maybe even unfair, but I promise you, by the end of this, the why behind that huge difference is going to be crystal clear.
So, here's our game plan. First, we'll talk about what the goal of pricing even is. Then, we'll dive into the core factors that are all about you. After that, we'll look at the machine that does the math, see it in action with a real-world example, and finish up with how you can actually have some control over that final price.
All right, let's start at the beginning. Before we can understand your price, we really need to get what the insurance company is trying to do. And trust me, it is way more than just picking a number they think you'll pay. Here's the key idea. Your premium isn't just a fee for your own risk. It's actually part of a much bigger equation. It's a carefully calculated price that's trying to balance four different things: claims, running the business, making a small profit, and staying competitive, all at the same time. Yeah, you can really think of it as this incredible balancing act. The price has to be high enough to pay for everyone's future claims and keep the lights on, while making just enough profit to stay in business. But if they set it too high, you'll just go to their competitor down the street. It's this constant tightrope walk to find that sweet spot. Okay, now that we get the big picture, let's get to the fun part, the stuff that's all about you. These are the key ingredients that get thrown into the mix to cook up your final premium. So first up is your personal risk profile. This is all about your track record. For car insurance, think about a brand new driver versus someone who's been driving for 20 years without an accident. For a house, a brand new building is just a different risk than one that's 100 years old. They're basically looking at your past to get a hint about your future. Next, they kind of zoom out from you and look at your environment. They use massive amounts of data to ask a simple question. How likely is it that someone will have to file a claim here? So if you live in a place with a higher crime rate, the probability of theft claim goes up. If you're in an area that gets a lot of hail, well, that's a factor too. It's all about statistics. But it's not just about if a claim happens, it's also about how big the bill will be when it happens. Think about it. A high-end luxury car doesn't get into more accidents, but if it does, that repair bill is going to be huge compared to a basic hatchback. That potential cost is called severity, and it's a massive piece of the puzzle.
And finally, a really obvious one: what you choose. If you opt for the gold-plated plan with really high coverage limits and a tiny deductible, you're asking the insurance company to take on way more of the potential financial hit. So, naturally, they're going to charge you more for taking on that bigger risk. So, just to recap, you've got these core ingredients getting tossed into the pot: your personal risk profile, the probability of a claim, the potential severity of that claim, the coverage you pick, and even some broader external stuff like local repair costs or even inflation. So, what happens next? All right, so how do all these different ingredients actually get turned into a price? Well, let's take a look inside what we're calling the premium calculation machine, where technology and human expertise come together. This is probably the most important thing to get. They are not guessing, they're not just throwing darts at a board. They use these super sophisticated computer programs called rating models. But, and this is crucial, it's not just a robot spitting out a number. There's a human touch too. The process basically works in 3 steps. First, all your data, all those ingredients we talked about, get fed into the system. Second, the automated model crunches all those numbers and calculates a price. But it's not done. Third, a professional underwriter, that's a person who's an expert in risk, reviews the whole thing to make sure it's fair and it makes sense. It's the best of both worlds: machine power and human judgment. Okay, Theory is one thing, but let's make this super concrete. We're going to apply everything we've just learned and look at two different drivers to see exactly why their insurance bills can be on opposite ends of the spectrum. So let's meet our drivers. First, you've got driver A. Picture this: a squeaky clean driving record, lives in a quiet suburban neighborhood, and barely drives 10,000 kilometers a year. Now meet driver B. Unfortunately, they've got a couple of accidents on their record, they live right in a busy city with tons of traffic, and they have a really long commute every day. You can already see their risk profiles are completely different.
So, what's the result? It's pretty clear, right? All of the data, every single factor points to driver B having a much, much higher probability of getting into another accident. Their unique combination of risk factors just makes them more expensive to insure, and their premium is going to reflect that directly.
But here's the really good news. Your price isn't just something that happens to you. This last part is all about what you can control. Your choices and your actions can literally move the needle on your final premium. You can absolutely be proactive here. Things like driving safely to keep that no-claim bonus, installing an anti-theft device in your car, or even bundling your home and auto insurance together, all of these things send a clear signal to the insurer. You're telling them, hey, I'm actively trying to be a lower risk, and for that, you get rewarded with discounts. And of course, it works the other way too. Certain behaviors act like red flags. Filing a bunch of claims or getting a lot of speeding tickets, those things are going to add extra charges or surcharges to your bill. They basically update your risk profile in real time, signaling a higher chance of future problems. So when you boil it all down, here it is. Your premium is not some arbitrary number. It's a price tag that's as unique as your fingerprint. It's a direct, calculated reflection of your specific risk, all balanced against the needs of the whole system. And that's pretty much the whole story. So I'll just leave you with this question to think about. Now that you actually know how it all works, what's one thing you can maybe change to improve your own risk profile and get a better deal? Thanks so much for tuning in.